No, what we're doing here. What we're doing is calculating an expense called depreciation, which we're going to record in the income statement. So remember, the format of the income statement is that profit is calculated by taking all of the expenses away from all of the revenue. We've already commented in the preceding lectures how profit is an accrual concept, not a cash concept. And you'll recall that we talked about recognizing revenue, and then we talked about recognizing expenses. And in the income statement, what we do is match the expenses against the revenue which they have helped to earn. And so our language here is very important. We talk about the matched expenses of having been incurred. Note that we're not talking about those expenses as having been paid, and nor are we talking about the revenue as having been received. So to repeat, profit is an accrual concept, not a cash flow concept. Expenses. We know what an expense is. It's a decrease in the economic benefits of the organisation during the accounting period, and it can be in the form of outflows or depletions of assets, or by incurring new liabilities that would result in a decrease in equity. So we recognise expenses when it's probable that there will be a decrease in the economic benefit, and also when we are certain that we can reliably measure what that expense is. Thus, in this mini lecture is that of depreciation. And depreciation always relates to a non-current asset. So first of all, for there to be an expense depreciation, you must have at some time in the past purchased a non-current asset. In this example, we're talking about the purchase of a machine. Typically, machines which are used in production or in administrative functions would have a lifespan of perhaps 2, 3, 5 years, maybe even longer if it's heavy machinery in a manufacturing environment. So the machine which we purchase has got a lifespan which is longer than 1 year, and therefore it sits in our balance sheet as a non-current asset. However, as we use that machine over its useful life, what we must record in the accounting environment, the accrual accounting environment, is the using up of that machine over its useful life. And so again, note that we're not recording the cash event here. We'll be recognising this expense called depreciation over the life of the asset. We don't recognise it at the time that the purchase is made. So what do we know about depreciation expense? Let's get a definition in front of us. Depreciation is a particular expense that is calculated by spreading the cost of the asset over its useful life. We need to be very clear that depreciation is not a process of valuing the asset. It's a process of spreading the cost over its useful life. Now, there are 3 basic approaches to depreciation, and we'll talk about each of those. They are the straight line method, accelerated depreciation, or the units of production basis of depreciation. Each of those 3 has a different formula that's applied. However, the meaning and the process are similar. That's to say, the meaning is spreading the cost of the asset over its useful life. What differs is that we use a different formula. So at this point, we can illustrate the process of depreciation in a large company by going into your Woolworths reports and locating the depreciation expense, which you'll find in the income statement. You'll also look on the balance sheet and be able to see which are the depreciating assets. They'll be in the non-current asset section on the balance sheet. Now, if you dig around and go to the notes to the financial statements, you'll then be able to examine the note which tells you the basis of the depreciation calculation. You'll see that Woolworths tell you the rate at which they're depreciating each of the classes of assets, and they tell you what the cost of the assets are, what the amount of accumulated depreciation is against each of those classes of assets, and calculate what is the written down value for that class of assets as well. So if you look back in the balance sheet, what you'll then see is that the presentation in the balance sheet is at its written down value. That's to say, the cost of the asset less all of the accumulated depreciation so far over the life of that asset. Now notice that to apply this method, you do need to know the cost of the asset, and you also need to know what is the expected useful life of that asset. And that's again because the process that we're applying here is a process of spreading the cost across the useful life of the asset. So those are two key pieces of information that you have to have in order to be able to apply the process of depreciation. Now, another thing you'll have to make a decision about is when you make a purchase, is whether that purchase is of an asset or whether you are paying for an expense. And so the distinction here is about the timing of the benefit which comes to the business from that transaction. And so what we're asking here, is the transaction one that will result in a past or a future benefit? Or stated differently, what you purchased has been consumed in the current year, or does it retain future benefit? Recall again that the definition of an asset includes a statement that there is future economic benefit for the organisation. So if you have consumed an expense and paid for that expense, then there is no future benefit for the organisation, and so we treat it as an expense and it shows up on the income statement. However, if we haven't consumed all of the value and there is future value which is yet to come, then we can say that we do have an asset, and in that case we'll be depreciating that asset using these processes. Help you to make the determination of whether you have paid for or whether you are incurring a cost or whether you are acquiring an asset. And so if you just work your way down that little decision tree, you'll see that you arrive at the decision point about where the benefit lies, whether it's present or whether it's future. And if you've purchased something which has got future benefit, then you've purchased an asset. If you've purchased something where all the benefits have been consumed, then you have an expense. Here are some examples. The question, asset or expense. I think most of us intuitively know that if we purchase a motor car, we'll have something which is of value to us for perhaps 2, 3, 4 or more years. And under those circumstances, what we've purchased is an asset. When we pay people their wages for working in the business, however, we're paying them for work that they've already done. And so the benefit's already been provided and we've consumed that benefit, and so what we have is an expense. Now, car rental again, if the benefit applies to the current period, so perhaps the current week or the current month, then it's an expense. But if by any chance you're renting a motor car for perhaps 2 or 3 years, then a portion of that, that's the portion which is longer than the current year, will be an asset. Depreciation is a way of tracking the consumption or the use of value from this non-current asset over its whole life. It is about matching the use of that asset with the income which is earned by the asset. Now, an important point, the third one here, do be aware that the process of depreciation never involves setting aside cash funds to provide for asset replacement. This is an accounting process of spreading the cost over the useful life. In no circumstances does depreciation set aside what you and I would call a sinking fund to allow for its replacement. We do ask ourselves the question, does depreciation help maintain the productive capacity of a business? And the answer to that is yes, it does. By spreading the original cost across its useful life, what we're doing is maintaining the original capital. The downside about depreciation, or weakness if you will, is that it ignores changes in the price or changes in the technology where perhaps your asset might become obsolete, and it also ignores changing business needs. So depreciation is not a strategic process. It's not designed to help us to decide about replacement. It is designed to maintain the productive capacity of the business by matching the cost of that asset over its useful life against the income that it earns. This terminology, let's just flesh it out here again. The written down value or the carrying value of the asset, sometimes also referred to as its book value, is calculated simply as the cost of the non-current asset less the total depreciation to date over its life. Now that total depreciation over its life to date, which might be 2, 3, 4 years, is known as its accumulated depreciation. The cost of the non-current asset less its accumulated depreciation. Now, if you're in an environment where non-current assets are being revalued, then the written down value of that asset is the revalued figure less its total depreciation to date. So that's a slight variation, but only a slight one.